Good afternoon, and welcome to the August 25th, 2022 Stonebridge Wealth Management Forum. Whew, that was a mouthful. Welcome, and we can't wait to introduce you to some of the concepts that we have today. But first of all, we'd like to make an announcement. 2022 is the 25th anniversary for Stonebridge Capital Advisors. We're excited to share that with you. And we want to make sure that we thank all of our clients and our partners that have made it possible for us to grow over the past 25 years. We appreciate working with you, and thank you for everything that you've done for us. Today, we're going to discuss a bit about one of the primary goals of our clients when we meet with them to develop their wealth plan. They work very hard to develop their wealth, save it, preserve it, build it, and now they're at a point in their life where they want to know, how do we transition that wealth? How do we transfer it to husband, wife, children, grandchildren, other family members, charitable organizations? And in doing that, how do we accomplish that? So today, we're going to talk about a number of the ways that we can transfer our wealth to those that we want to make sure receive that wealth in a tax-efficient way, as well as a way that is fitting with the estate plan that we put together for our clients. In doing so, Stonebridge's primary job is to work with the professional team that helps our clients develop that strategy and then implement it. And that would include their attorney, maybe their business attorney, their estate planning attorney, their tax advisor or CPA, could include their life insurance agent or property casualty agent. There are a number of partners that come along that assist us in developing that plan, and we coordinate that activity at Stonebridge Capital Advisors to assure we get to our clients' goals and meet their needs. So today, we're going to talk about a few of the ways. We couldn't cover all of them in a short period of time, but it's designed to hopefully give you just a thought in your mind about how you might want to transfer it and raise a question that might be helpful for you to meet your goals. So I'm joined today by two people that we've had the honor of working with on a number of client situations in developing their wealth plan and also assisting them in transitioning their wealth. So first of all, I'd like to introduce Sophia Grotkin. Sophia is with the firm of Randon Shakirov. I want to make sure I pronounce Shakirov. I'm sorry, it is a tough one. And Grotkin. Obviously, she is a partner in the firm, an attorney at law. They practice primarily in family and estate planning. I also have with me Steve Wormley, CPA, accountant with Dennett Kennefic, and tax advisor. So welcome. Glad to have you here. I can't wait to have our conversation. So I'm going to let Steve start our process. Go ahead, Steve.
Thanks, Bob.
Yep.
And thanks everybody for signing in. You were kind enough to give us a case study, and I'd like to describe the case study so that we can jump right in. But I do want to mention that in our experience, working on this kind of a project without a team approach doesn't work. We always have different things to add to the process. The other thing we have to remember when we do this, for everyone that we start working with in a couple, is that couple has to face, when we're talking, it's easy to focus on the numbers for us, for the accountants.
Not for me.
Right.
But we have to remember that they have to face possible early demise. And a lot of times that's a very difficult conversation. Mm-hmm. In this case, we have a very typical, or somewhat typical, successful couple. They're in their 40s. Husband and wife have 3 children at ages 18, 16, and 12. They already have wills. It's likely the wills are leaving assets to each other. That's typical. So if both of them would die, the successor would be the children. But it's a pretty plain and simple will. The children plan to attend college, all 3 of them. One's 12, so she doesn't really know yet. The wife is an entrepreneur. She owns a manufacturing company. And the husband is an executive with a large bank. He gets W-2 compensation. They've been successful at putting away some value to their assets. The manufacturing company for the wife is right now worth about $5 million. That's not liquid, that's not cash. That's an asset that has value if she sells it and when she's ready to sell it, or when the estate is ready to sell it. There's also real estate involved in the manufacturing company that's outside of the company, and the company's probably an S corporation, by the way. The real estate is worth, after the mortgage, net of the mortgage, about $200,000. And she also has a 401k plan worth about $350,000. That's all pre-tax money. Nobody has to memorize these numbers. I'm bringing them up so that people recognize that they might see themselves in some of these examples. The husband has accumulated an after-tax portfolio, likely managed by Stonebridge, or they wouldn't have been brought to us.
Well, we hope so. Yes.
Right. $750,000, and he also has a 401k plan pre-tax of about $350,000. They have a primary residence that has about $350,000 of net equity after the mortgage, and they have a second residence, probably a lake home, or in Minnesota, a lake home. It's fully leveraged, meaning they borrowed money 100% to buy it, probably bought it recently. It has no current value. The thing to remember about all of these assets is that they are likely to grow in time. So we have a plan. As we talk about a plan, we have to look at what are the current values, but also what those values might grow to and how to manage that. So at that point, the wife has a taxable estate. Her value of her total assets is about $5.7 million, and the husband has about $1.3 million. But they always forget, they also have life insurance. And if they were to die, the life insurance is considered part of the taxable estate. People don't understand that because they hear life insurance is tax-free, but that's income tax-free. We're talking about inheritance tax or estate tax. And in estate tax, you have to look at a snapshot of what is the value of all the assets, including the proceeds from life insurance, in order to measure what's the potential tax. Right. So in total, hers is actually 6.725, and his is 2.275, for a grand total of $9 million that they are worth at this point. And if they were to pass in a sudden accident, and they both passed, and they followed the will the way I just thought that it likely says, the assets would pass to the kids, and there's no federal tax likely, but a Minnesota tax potential of $780,000 if they do no planning.
Wow.
Yeah.
Sophia, what ideas have we come up with?
Yeah. So typically or hopefully in this situation, we hope that this couple is already working with professionals in our area of work, so as an attorney, estate planning attorney, financial advisors, and a tax professional. And we will have looked at their situation and identified really 3 primary immediate objectives that we need to accomplish. And the first objective that I would be looking at as an estate planning attorney is establishing the health and wealth conveyance documents that would actually transfer properly this couple's estate from owned by them as couples and transferred to their children or other beneficiaries.
So not necessarily a tax
motivation. Not necessarily a tax motivation, but actually establishing the goal of transferring wealth from parents to children or other beneficiaries. Because actually here in the situation where this couple has already established a will, which is a great start, they have actually not addressed the issue of the other assets that are a part of their portfolio, and we would want to make sure that we have actually effectively have a plan for transferring assets from the parents to kids. The other big red item that we have as an objective would be to reduce that estate tax. $800,000 of estate tax.
They have no idea. They walked into this meeting, they have no idea.
Right, and so primary objective, I'm sure for you, would be trying to reduce that $800,000 estate tax in Minnesota. And then lastly, for all the parents that are signed in and all three of us addressing college. We have an 18-year-old who's ready to go off to college in a few months. We have a 16-year-old who's probably already on college visits, and then we've got this 12-year-old that we have an opportunity to plan for a little bit more. And so for this couple, immediately I'd like to identify, how we can help them to pay for that extreme expense for all three children over time in a way that's also going to meet their goals, but also help them be able to transfer wealth maybe through the obligation of paying debt for kids. So really just at the outset, let's talk about that first goal, establishing the health and wealth conveyance documents that will transfer assets from the parents to children.
So the will's not enough.
So the will would not, it would be a start, but it's not enough. So what I wanted to say is, I have to commend this couple for establishing, an initial basic estate plan. And it's to no fault of their own, because the first, when you first have a job, you first have that first child, the first basic step is to just establish a will, and that's sufficient potentially for a very simple estate. But a will, and some people don't recognize this, is actually only transfers probate assets. So that's assets that do not have beneficiary designations associated with it. And it also requires that you open up a probate in the county and the courthouse in the county where you live to transfer those assets. And so it can be really cumbersome. And then thirdly, it doesn't address the issue of tax reduction options.
Right.
So what I would suggest this family do is consider establishing a couple of very, what can be straightforward if established correctly, estate planning tools or documents that can address a whole slew of flexible scenarios. And you've heard of this and worked on this with clients, is establishing a revocable grantor trust.
What's revocable?
So revocable is exactly as it says, it's a revocable, which means you can terminate it if needed. Estate planning document that is amendable during lifetime, which means that you can change the terms of it throughout lifetime. You can transfer assets into the trust, and you can transfer assets out of it during your lifetime. It's flexible.
One of the things I'd like to mention is with a revocable trust, the activity of the trust, the ownership of assets and the earnings and whatever, are invisible for the IRS. It's treated all as part of the individual tax return. There's no separate filing for a revocable trust.
That's a really good point. And that brings me to my kind of initial thought process with this family, which is that a revocable trust could be established for this family to transfer recommended assets into the trust. And then, in a situation where one or both parents were to pass away, those assets would transfer to the children or beneficiaries in a private setting, rather than requiring the establishment of a court proceeding or probate. And a lot of times the administrative piece of it is a lot more straightforward, because in a trust rather than in a will, you can actually provide for all of the instructions as to who's going to assist in the management of the transfer of this wealth.
The actor.
Exactly.
Okay.
And how. So what are the special instructions that you have regarding the assets that you've worked very hard to accumulate throughout the years, and when? So one of the special circumstances in this case is that we've got an 18-year-old, a 16-year-old, and a 12-year-old beneficiary. The 16-year-old and 12-year-old are not eligible to inherit funds from their parents at this point. And in addition, a lot of parents believe that, maybe 18, 16, there's a special sweet spot for inheriting a sizable amount of wealth. And in this case, I would consider that to be this to be an opportunity to plan for that as well.
Right.
Is when should these children inherit?
And the will doesn't do that unless the will creates a trust of its own. But
Correct. And so the revocable trust creates that opportunity. Primarily for this, for what you probably would like to accomplish is, in a revocable grantor trust, we can establish a disclaimer trust provision. And a disclaimer trust is a separate instrument that we provide for in a revocable trust that allows for, at the first spouse's passing, allows for the surviving spouse to disclaim some or all of the inheritance from the spouse that passes away, to avoid having those assets as being counted as part of the estate. And so it typically reduces the amount of tax, estate tax that's incurred at the first passing. And maybe you have you might have that number handy, but
I have an objective, and the objective would be to use up each person. I'll go into some of the details of what the tax rules are for estates, but basically in Minnesota, you can pass $3 million tax-free at each death. But if the first death leaves all the assets to the surviving spouse, then that surviving spouse has all that on top of their assets. So in a disclaimer trust that you're describing, the goal would be to try to carve out up to $3 million of assets that would be held in trust for benefit of the kids, not for the spouse. Perhaps earnings to the spouse, but the body, the residual of the trust would go to the kids. Yep. And that allows it to be taxed for Minnesota, but since it's $3 million, it'd be taxed at zero. Move $3 million out of this potential taxable estate, and you save $390,000 under current Minnesota law.
For our viewers, too, it's important to know, most of which are Minnesota residents, many of whom are around the country. So when we work with you and we work with your professional advisors, we're going to assess what kind of tax may be possible in your state of domicile. And that's obviously very, very important relative to making sure. There are some states that don't have an estate tax, and so there are other ways that we talk about transition of assets beyond worrying about that particular estate tax. So want to make sure you're all aware of that.
And not just the tax and the planning, but the trust itself might have to be written under that state law of where the grantor is domiciled.
And that is, and that is true. Another tool that I would suggest for this family is to consider an irrevocable life insurance trust.
So this is not revocable.
So it's not revocable. It's irrevocable, meaning it's permanent once the trust is established and the life insurance is deposited into the trust and held by the trust. However, if the intent of this family is to hold those sizable life insurance policies, so a reminder that it's $1 million per parent, so $2 million in life insurance. If they intend to hold that and keep that throughout their lifetime for the benefit of children or maybe each other, it would effectively take $2 million outside of the estate so that this couple would not be taxed from an estate tax perspective.
Not taxed to either husband or wife's estate.
So there are some pitfalls to that. There's a cost to maintaining that life insurance and that type of thing, but I think it's something that this family should consider, just given the amount of the estate and the fact that they're probably going to keep those sizable policies, given wife is an entrepreneur, they've got a sizable estate.
Could save them $260,000 to the kids. Instead of paying the government, they leave it for their kids.
Exactly. And then lastly, there's so many options. But lastly, I think from an immediate perspective, this couple needs to establish those living documents. So power of attorney and a healthcare directive document. A power of attorney document is a document that establishes a trusted person or fiduciary to manage financial affairs during
Before
your
death.
lifetime.
Before death.
Before death, exactly. And then also there's an opportunity to create a durable power of attorney to manage assets during your lifetime, as you stated, and in the event that you become incapacitated. So in Minnesota, at least, if you become incapacitated to the point where you're unable to manage your financial affairs, you have to, your loved ones or you need to become under a guardianship or conservatorship that's managed by the state in order to be able to have your financial affairs managed by anybody. And a durable power of attorney allows for you to identify who that individual would be before that were to occur. And it's really the least restrictive alternative in the event that a situation like that happens. And in this case, we have an entrepreneur. We have mom who's a business owner. We've got 3 young kids. We've got 3 relatively young kids. And it would be to their benefit and really a necessity to be able to establish who's going to keep the family afloat and assist in making sure financial affairs continue to run properly if needed, right?
Deciding on those people who are going to take care of your money or your family has always been the most important thing besides, forget the money. It's that. And it's also, when we work with clients, that's the hang up. We'll stop right there, and sometimes the clients will go away for months because they can't decide on and they have to face their potential demise. And then they have to decide who they can ask to take care of their stuff and take care of their kids.
Yeah. Input that I provide to my clients, because it's absolutely, even myself, it's hard because there's nobody better than yourself, right? Than to manage what happens with your money
and nobody will do it exactly the way you want it.
Exactly. But what I like to remind clients is, we're talking about the situation of if something were to happen today. Is there someone that could, just today could manage things? And sometimes that helps to know that you can revoke power of attorney, healthcare agents, and you can reestablish a new person. So these are documents that can be amended over time. Unlike the irrevocable trusts, these are amendable over time. Lastly, really just from a kind of a housekeeping to round out an estate plan for this couple, I do think that it would be very helpful and needed for them to have each to have a healthcare directive, just so that, and that's the person who identifies, who's going to make decisions for me from a healthcare perspective on my behalf if needed. And that plays into this financial conversation because sometimes that person needs to understand what your wishes are in order for your power of attorney, your financial professionals to be able to help manage, health care that you might need down the road and setting aside funds for that. So it all comes full circle.
That health care directive is important for the parents. It's also important for adult children. Particularly if you have a child goes away to school, they have a health issue, you want to make sure that they have someone in place that can come in and make the decisions for them because they're adults at that point in time.
Right, the parents may not be able to get information from the clinic.
Correct.
That they need to help and can't because they don't have permission.
Yep, and then just really quickly to point out that there's 3 kids in this family scenario, and conversations happen at the dinner table or at the family cabin, and we want to make sure that everybody's getting the same message regarding what mom and dad want to have happen with their health care. And it's a great document to be able to make that very clear, just to keep peace within the family too during really hard times sometimes. So. So that's just some ideas with respect to, the documents, the conveyance documents that would transfer wealth that I would suggest for a family like this in this situation. But there's, another primary way to transfer this wealth, and that's through, gifting. And also there's a lot of other tax reduction opportunities. So I'll just hand it to you then, Steve, to take it away with those topics.
Okay. I do want to piggyback on something you alluded to, and that is that with all of these documents, they can be changed, and they won't get changed. I know that you would typically do the documents, and then it might be a couple of years, 3-4 years before a law changes, and you reach back out and say, hey, a law changed, we better relook at your documents. I might be involved in annual taxes and getting a chance to talk to the client, once a year maybe. Stonebridge, how many times are you contacting and connecting with your clients? It's several times a year,
Typically 3 or
right?
4 times a year, and there's always one time during the year that we ask to talk with them very specifically about all of their estate planning documents. Even their beneficiary designations relative to any 401ks or IRAs they're involved with, to make sure there have been no changes there and it's set up properly. So, yeah, that's an annual event with our clients.
And really important because we also do the work on the estate after somebody has passed, and so we're there sweeping up and determining what happens. And so often we find that a beneficiary designation didn't get changed. Somebody got divorced, former spouse is still the beneficiary, all kinds of horror stories. So let me give you some basics on the estate tax rules. Okay. For federal purposes, right now, an individual can pass $12 million tax-free for federal. If your estate is under $12 million as an individual, you don't have to really think about, unless you're going to win the lottery, you don't have to think about the federal estate tax. Not only that, but if you don't use your full $12 million, you can pass it on to your spouse. The amount, if you died without using the full 12 million, the extra can be passed on to the spouse for federal purposes, and that's called portability. It allows the total, the couple to really pass up to $24 million tax-free for federal. In Minnesota, and that's the only state I want to address today, since that's what I'm familiar with, $3 million, and there's no portability. So that means that if the first spouse, in our example, if the husband passed and even if he were using some kind of a trust document to pass his full $1.9 million or whatever it was, 2.275, if he passed that fully to an entity that was the spouse, not the spouse, it was for the kids, so that it allowed that estate to be taxed at the first to die, it still leaves another $750,000 on the table that is going to get taxed on the second to die. So one of the goals we have whenever we do this is to try to balance between the parents, balance the assets, at the very least so that each one has at least $3 billion in their name. And that can be accomplished with specific assets. For example, in their case, it might be putting the title of the personal residence into the husband's name and not the wife. I don't want to be at that conversation, but it's that kind of an asset, or the real estate that the wife owns for the business, that could be put totally into the husband's name. Try to build up that asset. Another way, and you and I have talked about this, is having, what do you call it, a joint trust, or what's the? A
joint marital revocable trust.
That's a mouthful. But it's still a grantor trust.
Yes.
It's still revocable, but it's really owned by the two parents, and within that trust it can be used to balance the assets.
Yep.
That's good. Another tool that's used is that every year each spouse could give up to $16,000 to each of their kids without reporting it, without it being included as a gift or a reportable gift. They could do that. Of course, it puts the money, unless it's used in a different tool, it could put the money into the kid's name, and when they're 18, is it 18 in Minnesota? When they're 18, they have rights to that money unless it's protected in some other kind of specific account or in a trust. The other issue on that $16,000 each, though, is that some of these other strategies that we've talked about, including the irrevocable life insurance trust, when the parents pay the premiums to the life insurance trust so that the life insurance trust can pay the premium on the policy, that's a gift. It's considered, and if it's done right, it's a non-reportable, it's part of the $16,000, but it gobbles up some of that $16,000 that's available for each gift.
Let's talk a little bit about the simplest tool, estate planning tool that's out there for people that can put a lot of smiles and love in your family, and that's by gifting before you pass. Can you tell us a little bit about the tax implications of that and the simplicity of it?
Well, a gift isn't an estate tax, right? But a gift is treated as, if it's a reportable gift, meaning more than the $16,000, that gift gobbles up part of the allowable amount that can pass at death. So if you successfully gave away $1 million, you only have $2 million left at death to go tax-free. Another issue about gifting, though, is unless it's done in a trust or some other way that protects that gift from your kids wasting the money or spending the money, accessing the money, or even their creditors or judgments if they got into a car accident or if there was some kind of a judgment against them, that gift, looking backwards, could have been a big mistake. On the other hand, mathematically, it's a very powerful tool.
It is.
So in our example, we might even consider gifting, for example, the real estate related to the wife's business. That real estate, I said, could go to the husband, but it might go very well to go into, let's say, a limited liability company that is gifted to the kids. The governor of the LLC would still be the wife, so she would still be in control of the LLC. And the asset, which right now is $200,000 net value, that's a $200,000 gift, and there may be ways to reduce that with discounting, but let's just say it's $200,000. Over time, that value is going to go up because the real estate will go up and the mortgage will go down as the business pays the mortgage. And so you're going to grow that amount that has been permanently taken away from the taxable assets of the parents.
Yeah.
But it's in the kid's name, and you have to remember there's risk there.
Yeah, but a really interesting tool if you're a business owner to be able to leverage if it's the right opportunity.
Right. Right. We talked about irrevocable life insurance trusts.
Yep.
That goal, what we just talked about, is one of the objectives, is to transfer assets before death to remove both the current value and the potential growth. And that would be true of cash assets in the portfolio. It could be true of a lot of different assets. Even the manufacturing company, which is the family's largest single asset, it's an S corporation. It's got some unique rules about being put into trust, but there are ways to do it where you could transfer some of the value and the growth of that S corporation to the kids.
Now the tough one, that third objective.
Yeah.
How are we going to pay for college?
How are we going to pay for college? And this family is not dissimilar to many clients that I've worked with. They likely don't have the current cash flow to be able to pay for their college education for the kids right now. They're building some wealth each year, but it's very likely a lot of it is being plowed back into the business. It's being tied up in the 401k plans. There are tools, and one of the tools that is often brought up is a 529 plan. A 529 plan has some unique benefits, but the overall use of a 529 plan is to shelter the earnings on the 529 plan from tax. So money goes in, it earns money, and if it's used for eligible expenses when available, the earnings are tax-free. If you did that plan for the 18-year-old today and you started taking the money out tomorrow, there's no earnings, no real benefit. If you do it for the 12-year-old, better idea. Be aware, those contributions by the parents into the 529 plan are again eating up that $16,000 a year.
So it would be a part
benefit.
of your annual gifting.
Would be part of the
exemption.
annual
Yep.
gifting. You can do some acceleration, but it eats up that amount for a number of years.
Sure.
It's a great tool if they happen to have grandparents. The kids have grandparents that are interested in funding some of their education. 529 plans are fantastic for that. So one of the things we always ask is, have you reached out to the parents? We say, have you reached out to your parents to see if they intend to contribute to the kids' education? Because if they do, it's better that they do it early through a 529 plan, make a big contribution. They can contribute up to 5 years worth of $16,000 gifts in one time. Use it all up at once to get it working for for the account. It's a great tool for grandparents.
So now what happens if this 12-year-old doesn't want to go to college or doesn't need to utilize funds for college, gets a swimming scholarship or something like that? What happens with the 529 plan?
Yep, the 529 plan can be used to transfer to other beneficiaries.
Okay.
So perhaps one of the other kids goes on to graduate school. Okay. Or even, I said the 18-year-old might not be eligible or a good eligible party for the 529 plan, but maybe they are because let's say the grandparent put in, what's 5 times 16, $80,000. They put in $80,000 for the 18-year-old, but the 18-year-old doesn't use it because it hasn't generated anything.
Yep.
But over time, later, when the 12-year-old is ready, that's another 80 grand plus earnings that is available for the 12-year-old.
Right.
Great.
So that's kind of slick. However, people get hung up on the 529 plans. The 529 plan, again, is just a way of sheltering the earnings. But what you really want to look at is the overall after-tax return of a planned portfolio, which might include 529 plans, especially if you use grandparents' money, because they like to see that money tied up
Right.
for one purpose. But if it's the parents, they really want to look at the full portfolio. They want to look at, maybe they want to be more aggressive on their investments, even though it's going to pay some tax. Paying tax isn't the end of the story. It's after-tax return. And there again, that's where Stonebridge comes in.
Sure.
Other vehicles are available as the kids start looking at college. One of them is just plain old student loans. If you're trying to maintain liquidity for the parents during those years, and I know I did, we use loans. And then over time, we're able to pay off those loans, but it gives us the time to do it and not be hung up with the actual moment that the kid needs to go to school. There are other concepts like Roth IRAs. Now, the parents probably aren't eligible for Roth IRAs, their income's too high. But the kids might be. The kids might have earnings that from summer jobs or whatever. And to the extent they have earnings, the parents could gift an amount to them and put it into a Roth IRA in the name of the child. And that Roth IRA then would be available. It would be a gift, again, taking up some of that $16,000. But it would be a gift from the parent to the child into a Roth. Legally, I believe the child can access that Roth account when they're majority, 18, right?
Yep.
But usually we work with clients, they've communicated well with their family. They understand you can take that money out, but we're not going to fund any more college costs, Sometimes the kids will say, I don't need that. But if they don't end up using that Roth money for education, that Roth money might be available for a first-time home buyer. So the Roth can be a positive thing to use.
And a good opportunity to be able to see some of that wealth be enjoyed for things that can otherwise be a stressor for kids and those big opportunities, college, first home, wedding, those types of things.
Right. Yeah. So not only the parents' current income being a little bit of it carved off to start funding college and continue to funding college, but some of that $750,000 portfolio maybe needs to be used to take advantage of some of these portfolio strategies.
Sure.
Yeah.
I do want to talk about gifting for Minnesota. You brought up gifting, and so let's say that they gifted a sizable asset, $1 million. They gifted into a trust or whatever that was for the benefit of the child, and it was a reportable gift. The parents had to file a gift tax return federally. Then, for federal purposes, that would reduce the amount that they could give tax-free ultimately. For Minnesota, it would too, unless 3 years passes from the time of the gift until the time that the parent dies, the donor dies. If 3 years has gone by, the gift is ignored. So it's a real opportunity in Minnesota to take advantage of strategic gifting of significant assets to minimize this gift tax problem.
Right.
And that's the point where a lot of times, as an estate planning attorney, I do have the opportunity of working with families after death to administer estates and assist with the transfer of wealth through the trust or whichever tool they choose. And that's one of my first suggestions, is always to contact a tax professional to determine when these timelines are, so that you're maximizing on opportunities just like that.
Right. I do want to circle back to one thing that you talked about, was a disclaimer trust. We talked about a lot of the math going into how to do all these things. What the disclaimer trusts do is give you the opportunity at the date of death to measure how much assets and which assets the family is going to transfer in trust to the kids. You don't have to know everything on the day you sign the documents. The disclaimer trust gives you all kinds of flexibility when you're drafting the documents. It gives them after death. It's post-death planning.
I think one of the things that some clients get nervous about with the disclaimer trust is, well, what if I need that money? At the moment of time when the first spouse passes, that's a scary time. You're doing a lot. You're making a lot of decisions solely, with your professionals. And one of the questions is, what if I need that money? What if I have to access it? And one thing to remember with the disclaimer trust is that it is accessible to the extent of, under parameters like for your care and your lifestyle. So it's not completely inaccessible for the rest of your life. There's just rules around, what expenditures it's accessible to. So just keeping that in mind, that it's even though it would be irrevocable, there are measures to be able to retrieve those funds if you need it for care, that type of thing.
All of these ideas work, but they all add complexity.
Correct. Yep.
And I'm sure you've got a number of other even more complex tools to use.
Yeah, we've gone through a whole entire scenario that we would, in real life, we would be working with this family for quite some time to really make some methodical decisions. And I think everybody at this couch, should I say, would agree.
Non-table, yes.
Yeah, would agree that really there's a lot of options here. We didn't even go into annuity trusts, other S corp LLC options, those types of things. But the thing
Charitable
to keep
giving.
the thing to keep in mind is there's gonna have to be a balance for every family on minimizing tax and minimizing complexity. Everybody has a threshold as to what can really be managed in a lifetime and how many opportunities we can really take advantage of. And I like to just suggest, do what you feel you can manage and what you will follow through on. Right?
Oh, yeah,
Because if a plan, we have all these great ideas, but if it's not going to be manageable, then it's not going to be followed through on, and it's just not going to. It's not you. It's not your plan. So just keep that in mind. It's a balance.
Right. I've seen trusts set up and then never get funded. They never transfer the assets into the trust.
I have two.
Right.
And it's so important to have a team watching that whole process.
So,
Indeed.
I mean, really, if you even, for folks that are signed in, I think the point of this discussion is, we took a very real, potential scenario for a family that we might have in our office, and
Fairly
that
simple
we
family,
work with, and that we would work with as a team. And if we could have a moment in time with them, kind of what our three goals would be. It would be establish those transfer and conveyance documents so that we have a legal tool that will transfer this family's assets from parents to children. So we have a means. Let's reduce as much tax as we can based, with just consideration of complexity. And then let's accomplish that goal of getting your kids through college. So that's a major accomplishment for parents.
And get them to have good jobs so they can support the family after.
Exactly.
Now, we have talked about transition of assets in this scenario, largely to children. Now, there are certain circumstances where it may be other family members.
Oh, right.
It could be nephews, cousins, could be your aunt who is of ill health and you want to make sure they're cared for. There are lots of ways to do this. Some are more complicated than others. And one thing that we have ignored, not purposely, but there are also charitable interests that many of our clients see, and the alternatives for donating charitably either during lifetime or providing for a charity after you passed away. So those are the things that we'd certainly love to talk with you about in more detail. And I think, are we kind of set for time right now?
I think so.
All right.
Thank you so much for having us.
Yeah,
It's been
thank you.
It's fun.
Thank
to talk
you all
through
for
these
joining
scenarios.
us. We really appreciate it. We've enjoyed it. I know it's spellbinding. We're going to have this film on our webpage, so you can go back and revisit it if you would like to. Having a tough time sleeping on a Saturday night, you pull this up and watch it for a few minutes. You'll be all set. But also, if you have friends that you think might be interested, you can refer them to our webpage. Also, your questions are really important to us. And in our invitation, we gave you Michelle Turkowski's email address. Please email your questions to us. We'll reconvene this team. We'll review those questions and answer them on a video, and then place that also on our webpage. But even more importantly, if you have a burning question or a burning thought in your mind that impacts you specifically and you'd like more information, please contact us, call us by phone or email us, and we'll make sure that we get back together with you. So
Great.
thank you, folks.
Thank you.
We really appreciate it. It's been fun. Take care, all.